The term stock market melt-up is being thrown around left and right by experts and media outlets, with some getting very excited and some believing this is a disaster about to unfold. Indeed, a simple 15-year chart of the S&P 500 index shows a very aggressive uptrend in the stock market recently, yielding a massive 40% return just since October of last year, making the comparison to previous market melt-ups like 1999 and 1929 seem increasingly more plausible. A 40% gain on the S&P 500 within the space of a year is something that we've seen a total of 15 times since 1927. All of them are highlighted right here. So over the course of the last 95 years, what we're seeing today has only happened 15 times and means we can probably classify this as a melt-up. The question is whether these returns can actually be sustained or whether this melt-up is inevitably going to be followed by poor returns looking forward, or even worse, a stock market crash. Something that, for example, happened following the 1999 and 1929 melt-ups. But while these crashes are definitely very famous, we can also see that some of these melt-ups actually mark the beginning of very strong and healthy prolonged periods of uptrend on US stocks. There are aspects of today's market melt-up that are a little bit less healthy, however. For instance, how expensive the market is today. We're getting to some pretty extreme levels. Now, the expensiveness of the market at any given point in time is a concept that a lot of people have a difficult time grabbing, because over the long run, the S&P 500 only goes in one direction, and that is up. As you can see from this line right here, stock market earnings just seem to go up in price over time, which drives the S&P 500 index up over time. Because the price of pretty much everything in the economy generally goes up over the long run. The cost of a home went from $12,000 in 1960 to $400,000 today. The cost of a loaf of bread went from $0.2 in 1963 to about $2.2 today. That's just the nature of our financial system. The price of things go up, including stock market earnings. But we can know how expensive the stock market is by comparing the S&P 500 index relative to the earnings of S&P 500 companies. So removing that component that goes up forever. And when you do that, you get something that looks like this. This is the Shiller price to earnings ratio, and it provides a measure of how expensive the stock market is, which does not go up forever. Currently, the S&P 500 is at a PE ratio of 37, which is one of the highest levels we've seen in history. So that's the unhealthy part of what is happening today. If you're a long-term investor in the stock market, these high valuations are the last thing that you want to see, because it usually means that stock market returns over the next 10 years are going to be low. And I can prove that out. This is a chart that shows us the 10-year return of the stock market at any given point in time. So typically the S&P 500 can return as much as 300% in 10 years and as little as negative 50%, meaning the S&P 500 actually loses half of its value over the course of 10 years, which is what happened between 1929 and 1939 and between 2000 and 2010. And when we add back that chart of the stock market's valuation, but flipped around, you can see that valuations actually predict almost perfectly what the 10-year return of the stock market is going to look like. And right now it's predicting that the 10-year returns of the stock market from today's valuation are going to be very, very low, potentially just as low as in 1999 and 1929. That's why we say that the high valuations of the stock market today are unhealthy, because they're squeezing out all of the potential return you can get from stocks over the next 10 years. But if this is true, how come valuations continue to climb higher? They've gone up by 20% just in the last couple of years. How long is this going to last? And how far up can they go in this stock market melt-up that we're seeing? Maybe this is a new paradigm, right? Maybe this time is different and we are in a new era where market valuations should naturally be higher. Now, believe it or not, there are arguments that do support this, because S&P 500 companies have never been as profitable as they are today. As a result of the tech boom since the 1990s, we've seen corporations automate processes, increase productivity thanks to the internet, computers, mobile phones. Although these things have had their fair share of negative impacts, these are technologies that have significantly improved our way of communication in our access to information. And corporate America has benefited from this massively. This is a chart showing the profit margins of S&P 500 companies over time, and indeed since the 1980s, following the internet and tech boom, we've seen profit margins expand from an average of around 6 to 7% all the way to an average of 10% over the last few years. Corporations today are more profitable than ever, and the profitability of a business is one of the major factors that you should take into consideration as an investor. And it's very likely that you'll be willing to pay more to own a very profitable business than a less profitable business. So this increase in profitability partly explains the high valuations that we have today. It doesn't really make sense for the stock market to be priced today in 2024 to the same level as in 1873. Things have changed dramatically since then. In fact, I would go as far to say that the long-term average of valuations shouldn't be at 15 anymore. It should be more towards 20 instead, reflecting a generous 30% increase in corporate productivity and an expansion in profit margins over the last few decades as a result of advances in technology. The problem is, today valuations are nearing 40, more than twice the long-term average, and that's just not something that the higher profitability can justify. After all, corporate profit margins have expanded by 30%. They haven't doubled. The other problem is that nothing says that corporate profit margins will stay this elevated. You can see that during recessions, corporate profit margins can contract quite substantially. We've seen this occur in pretty much every single recession throughout history. So we'll only really know how resilient these high profit margins are in the next recession. Our personal bet would be that profit margins end up contracting quite substantially in the next recession, which could lead to a decline in market valuation. That being said, until we see that recession, this remains the most profitable stock market that we've seen since 1940. And that's a big deal. The stock market today is about 20% more profitable than it was in 1999. So theoretically, there's no reason why valuations couldn't be higher than they were back here. And if we look at what valuations were back in 1999, they reached 43. So if the stock market melt-up continues towards these valuations, it could potentially fuel a lot more additional upside in today's market melt-up. Even though we expect a recession to materialize by January of 2025, and we believe these high valuations will eventually deflate and lead to low returns looking forward for the S&P 500, we also know that we don't have a crystal ball, and our strategy over the last 2 years has been to not bet against this market. Anybody who's been watching these videos for the last 2 years, not just reading the titles, has gotten this consistent message that although we're very aware of the massive risks, we don't have any signs that this bull market is done yet. Our strategy has been to respect the uptrend that's in place on US stock market indices, using all of these dips as opportunities to initiate new trades on our website that have been very profitable and have helped our clients stay ahead of 90% of traders out there. You can see on our homepage on our website all of our closed trades from 2024. These are the most recent ones, and as you can see, we're still putting in some great winners. Make sure to join our website if you're interested in following our strategy and all of our trades at bravosresearch.com.